Inflation report looks problematic on the surface. The Consumer Price Index, also known as the CPI, showed an increase of 3% for the 12 months ended in January. This is important because it was higher than the estimate and December's reading, which were both 2.9%. The headline annual rate has now climbed for 4 consecutive months after September's 2.4% reading. This likely is due to less benefit from energy prices, which did climb 1% over the last 12 months. At times in 2024, energy saw nice declines, which helped reduce the headline inflation number. Food costs, well, those were also a little hot at 2.5%, largely thanks to a year-over-year increase of 53%. That's right, 53% for the price of eggs. The core CPI, which includes food and energy, was also hotter than expected. The annual increase was 3.3%, which was above the expectation of 3.1%. While this does match the December reading, this measure appears to be stuck. Since May 2024, the annual core CPI has been in a range of 3.2% to 3.4%. While shelter costs remain high and a large factor for the higher inflation, the annual rate of 4.4% was the smallest 12-month increase since January 2022. I do see that as a positive. With that all said, I wouldn't say this report was a major positive, but I don't believe it provides any reason for the Fed to change course and look at increasing rates. This ultimately is just one data point that is subject to change in the coming months, but with this current data, I would say this makes the case for the Fed to continue to hold rates steady. Tariffs, well, those remain a big question mark for inflation as well, and it will be interesting to see how they impact the annual rates and also too the Fed's forecasts in the coming months. I'm Chase Wilsey with Wilsey Asset Management. If you like these videos, be sure to give it a like or comment, and feel free to check out our other YouTube videos and weekly newsletter for the latest economic news, expert analysis, and market insights.